Hi, this is Hutch with bankingtruths.com, and today we're going to talk about historic market movements and how that applies to index universal life going forward. So we're going to start with the Dow Jones Industrial Average because we can go way back to the 1900s. But I first just want to show you that the Dow Jones, when compared to the S&P 500, they really move in tandem and they're not that dissimilar. So we can use that Dow Jones as a proxy to go way back. So if we look at the last 2 years, you can see that the two tend to move in tandem together. When one's going up, so's the other. If we stretch this out for a 5-year chart, we can see very similar movements. And even if we go all the way back to 1985, again, we can see that these two indices tend to move together. So with that, let's go to this Dow Jones Industrial Average chart going all the way back to 1900. Today we're in 2018, and people often say, what if it's different going forward? I know what's happened in the past, but there's been a lot of volatility and events that have moved the market. World wars, inflation, hyperinflation, deflation, depressions, recessions, everything else. Our country has been through it. And generally what happens is markets consolidate for a while, they trend, they crash, they consolidate, they trend, they consolidate, they trend, they crash, they trend, they crash. That works out to be like a consolidation, but pretty major if you remember the last decade. And again, now we're trending. But what I want you to notice is in no time does the market just go down and down and down and down and down and keep going down. If it does, we all have much bigger problems than our paper assets, whether it's insurance or stock certificates or deeds to real estate or closely held business interests or whatever. So if the market continues to do what it has done since 1900 and what it has done in this particular study since 1937, this study here is done by a third-party mutual fund company, and we're going to look at what the market has done and apply that to index universal life going forward. So this is critical thinking. There's no guarantees here, but again, we just saw how the market behaves, and this is a pretty long study period in its own right. So 62 of these 81 years were positive. 19 of these 81 years were negative. And although this mutual fund company is giving us averages of the actual markets, we're not going to do that. We're not going to focus on the averages. We're going to think critically about what IUL would have done in these different market environments. And obviously the biggest benefit is during the negative years, we can wipe out all of these negatives and replace them with a contractual 0% floor. And by doing so, we able some of that volatility that we saw on the previous page. So something like this, if you've worked your whole life to retire, you may never come back to that. You may never come back from that. So even though the market rebounded, if you have to take income from your portfolio or wait an extra 10, 15, 20 years to retire, that may not be a good thing for your unique situation. Same thing with even a consolidation period like this, or the lost decade, as many of you remember. And again, we can wipe that out with how index universal life is structured, at least for that pool of assets. So perhaps you could draw from your index universal life while your mutual funds and stocks heal. So let's also take a look at the positive years. So one of the downsides of index universal life are the caps. And in today's day and age, the typical caps you're going to see are 0 to 11, a 0% floor and an 11 or 12 or maybe even 13% cap, which is pretty nice, but you're going to miss out on those big trending periods we saw. Maybe. Let's take a look. So of these 62 positive years, remember this is 62 out of 81, only 10 of them resulted in periods where you earned 0 to 6%, where you could still earn a positive return in your IUL, but you probably could have done so anyway or close to that by just choosing the fixed account. Actually, in 2018, a lot of IULs have a fixed account option where you can just choose this and get somewhere between, call it 3 to 4% without having to worry about getting a 0 in a negative year. but at least you can get positive crediting. We can see that 9 out of these positive years, you get between 6 to 12%. And this is right in Index Universal Life strike zone because it's obviously greater than the fixed account. And to be able to earn double-digit returns without any worrying about any of these market losses is pretty favorable. However, with a traditional IUL cap, what you're missing out on are all these other years. So there's 8 years of this 62 where you could have earned 12 to 18. There's 16 out of the 62 where you could have earned 18 to 24. And there's 19 out of this 62 where you could have earned over 24%. And obviously you'd hit your cap in Index Universal Life, but you'd miss out on some of these excess returns. And that's why we like carriers that offer some sort of uncapped option. And they're becoming more and more common inside Index Universal Life, oftentimes with something called a spread, which acts like a fee. It's not a fee because you only get charged in years where there's positive returns. So there would be no spread if you were to earn 0 down here. You just wouldn't get charged a spread on top of that. But in today's markets, a lot of times the spread is negative 5%, let's just say, in order to get an uncapped option. So what would happen in these 10 periods out of this 80 or out of these 62 positive years, and actually out of that total 81-year study period, you just would not get any positive crediting. You get a 0, and there may be some cost of insurance that would erode your cash value somewhat. In this 9 years, it would reduce whatever return the S&P provided by 5%. So they would just take this spread. Again, it's like a fee, but only in positive years. So you would have been better off in these periods just choosing the traditional 1-year S&P cap. However, in these years, right? So in years there's 8 positive years where it was over 13%, 16 positive years where it was over 18, 19 positive years where it was over 18, where you may not be negatively impacted. Actually, these may be close to a wash, and it depends on the exact nature of the return. But if you subtract 5 from these returns, actually it'd probably be a little worse than a wash than if you just chose the 1-year S&P cap, but it wouldn't be devastating. But take a look at these years. If we subtracted 5% from all these periods where you earn 18% or more, you'd probably be better off than just choosing the 1-year S&P cap. And we could just take this one, 30 minus 5, 25, that's pretty good. Even 19.5 minus 5, that's 14.5. 22.5 minus 5, that's 17.5. So there's 16 plus 19 years. That's 35 years out of these 62 positive years where you would have been better off choosing the uncapped option, which is pretty nice to have in your portfolio. And it doesn't have to be an either-or conversation. So you don't have to choose, well, this or that. Right? You can, in an Index Universal Life, you can often say, you know what, I'm going to put 60% in my uncapped option, and maybe I'm going to put 35% in my 1-year option, and you could put 5% in that fixed account. Let's just say it's earning 3.5%, just so you make sure that you get a little something, a little positive crediting for a portion of your cash value. In case there's a down year and you don't get anything, right? There's none of this. You just get a down year, but you get a little bit. 5% of your cash value earns 3.5%. So these are the options and things we look at when considering Index Universal Life policies, given somebody's risk tolerance. The other thing is people talk negatively about market timing in the context of stock investing, and it's understandable because they show there's studies by Dalbar that shows average investor returns, how they buy at the top and sell at the bottom. But with Index Universal Life, it could be different. So since you're always going to have that 0% floor, and if you choose any of the options, you're going to participate in some of these upside movements, then maybe you could be a little more tactical in choosing, we just had a big rebound. I think I'm going to allocate a little bit more to the uncapped options. Or, we're in this choppy period and I'm not sure what's going to go on. So maybe I'm going to throttle down the uncapped option and just choose the 1-year S&P and maybe blend it with fixed account. And well, there's been over a decade now where we've consolidated, and I think we're going to go to the moon. So I'm going to throttle and choose a little bit more of the uncapped option. I don't mind people being a little more tactical with Index Universal Life because you're not risking missing out on participation, since you have some sort of choosing any of the strategies, you're going to get something in your upside. And in the down years, you're not going to have to worry about losses that you're going to have to make up for.